Happy Thanksgiving, guys. So, I've been looking at the newest housing data, and there's one question nobody seems to have an answer for. How are foreclosures rising at the same time mortgage rates are falling and home inventory is finally improving? That shouldn't be happening. Not together, not this fast, but it is. And if you understand the real reason behind this pattern, you understand exactly where housing and your wallet is heading next. So let's start with what we're supposed to believe. Rates are easing inventory and slowing growing. Buyers' competition isn't as insane as 2021, and sellers are beginning to negotiate again. On paper, that sounds like a healthy market, don't you think? But right underneath that surface, more families are falling behind on payments. More homes are slipping into pre-foreclosure. More lenders are filing default notices. And the number of formal foreclosures actions just climbed from the 8th straight month, with over 36,700 filing last month alone. That's not a tiny bump. That's a real shift, and it's sending a message the headlines aren't covering. It's not the wealthy homeowners that are feeling this first. It's not cash buyers, and it's not investors neither. It's first-time buyers, families who use low down payment programs, and anyone who stretched to get into a home when prices were peaking. People who bought thinking, if we can just keep up with a mortgage, we'll be fine. Except that wasn't the whole picture. Because today, being a homeowner means juggling between insurance, premiums that jump every renewal, property taxes rising year after year, utilities eating more of your budget, repairs costing more than ever, groceries and everyday items rising with no break. So even if the mortgage stay at the same, the cost of staying in that home didn't. And for thousands of families, that gap, that slow, steady tightening finally snapped. Here's the truth. Nobody's simplifying clearly. Foreclosures aren't rising because of mortgage rates. They're rising because of everything else. The pressure isn't coming from the housing market. It's coming from the life market. The cost of being a person right now is higher than the cost of borrowing money. Think about that. Mortgage rates got a little better, but insurance jumped. Taxes jumped. HOA fees climbed. Childcare went up. Food hasn't eased. Medical bills haven't eased either. Families didn't get hit by one big thing. They got hit by 10 little things all at once. And those small increases pile up until keeping the home becomes a battle. Some states are feeling this pressure way more than others. Florida has been hammered by insurance shocks. Some counties, some homeowners' premiums doubled in 2 years. Foreclosure filing jumped, especially around Tampa and Orlando. Texas is facing rising property taxes and high insurance claims. Families who stretched to buy in between 2020 and 2022 are now dealing with monthly bills that look nothing like what expected. Illinois, especially Chicago, continues to battle high taxes and slowing wage growth. South Carolina is seeing rapid growth, but with fewer insurance carriers and rising storm-related costs that push premiums up. Different states, but the same story. Costs quietly push families to the edge, long before the lender ever show up. So what happens next? More distressed? Listings hit the market? Not enough to crash prices, but enough to cool them in certain neighborhoods. Banks tightening lending standards. That means higher credit scores expectations and fewer risky loans approval. Home ownership gets more expensive, not cheaper. Even if mortgage rates fall again, insurance and taxes would likely to stay elevated. Renters feel the same pressure too. When investors sell struggling properties, rent option shrinks, which pushes rents up. Buyers will need cushion money, not just a down payment. The new era of home ownership is about planning for the hidden costs, not just qualifying for the loan. There's one indicator I'm paying close attention to, and it's not foreclosure filings. It's early stage delinquencies. The 30-day late payments, the family skipping 1 month to catch up on another bill, the homeowners choosing between their mortgage and their insurance renewal. That's the pipeline. And it's growing faster than the official foreclosure count. When early delinquencies rise, foreclosures follow. Always. The housing market isn't collapsing, but it is revealing something important. Rates aren't the problem anymore. Life costs are. The rise in foreclosure isn't about bad loans or irresponsible buyers. It's about the reality that for many households, the cost of simply staying afloat has risen faster than their paychecks. So if the numbers don't make sense right now, it's because the headlines are telling one story and real life is telling another. And that's the difference. That gap is exactly where housing is heading in 2026. Thanks for watching Wallet Watch USA. Stay tuned for more updates that hit your wallet.